If you filed a tax extension this year, your 2025 return is due on October 15th. That part most people already know. Here's the part a lot of people don't know, and it matters most if you or your spouse have turned 65. There is a deduction on the 2025 return that simply did not exist a few years ago. It's worth up to $6,000 per qualifying person, and because it's new, a lot of people filing on extension this October are about to walk straight past it. Over the next 10 minutes, I'll show you exactly who qualifies, where the income limits kick in, how it works alongside your standard deduction, and 4 other mistakes that extension filers make every single year. Let's get into it. First, let's clear up the single biggest misunderstanding about tax extensions. An extension gives you more time to file. It does not give you more time to pay. If you owed money for 2025, that money was due back in April. The extension moved your paperwork deadline, not your payment deadline. So, if you've been sitting on an unpaid balance since April, interest and the failure to pay penalty have been quietly running this entire time. That leads to something worth understanding, because it changes what you should do if money is tight. The penalty for failing to file is significantly larger than the penalty for failing to pay. They are 2 separate penalties at 2 very different rates, which means that even if you cannot pay the full amount you owe right now, filing your return by October 15th is almost always the better move. File first, then deal with the balance, whether that means a payment plan or paying it down over time. What you don't want to do is skip filing because you're afraid of the bill, because that's the more expensive mistake. One more thing on the deadline before we move on. October 15th applies to most individual filers, but not everyone. Taxpayers in federally declared disaster areas often get additional time automatically, and there are separate rules for people serving in a combat zone. If either of those might apply to you, check the IRS Disaster Relief page, because your actual deadline may be later than you think. Now the main event. For tax years 2025 through 2028, there is an additional deduction available to taxpayers who are 65 or older. It's worth up to $6,000 per qualifying person. Let me be precise about 3 things, because this is exactly where people get it wrong. The first thing is that it's per person, not per return. A married couple where both spouses are 65 or older can potentially claim it twice. That's a meaningful difference, and it's the detail people miss most often when they're reading about this in a headline somewhere. The second thing is that there is an income phase-out. The deduction begins to shrink once your income passes roughly $75,000 if you're filing single, or $150,000 if you're filing jointly. Above those thresholds, it gets smaller, and eventually it disappears entirely. So if you're a higher income retiree, you may qualify for a partial amount or for nothing at all. Don't assume the full $6,000 applies to you until you've run your own numbers. The third thing is that age is measured at a specific point in time. What matters is whether you had reached 65 by the end of the tax year in question. If your birthday landed late in the year, you may still qualify. The exact rule is spelled out in the Form 104 instructions, so check it there rather than guessing. Here's why all of this matters specifically for extension filers. If you prepared your return back in the spring using an older worksheet, or if you're working with a preparer who is racing through a stack of October filings, this is precisely the kind of new line item that gets skipped. So, before you sign that return, look for it. And if it isn't there, and you believe you qualify, ask why not. A question I expect in the comments is whether you have to itemize to claim this. This deduction is designed to sit on top of your standard deduction. It's an additional amount, not a replacement. So, for most retirees who take the standard deduction, this is added value rather than a trade-off you have to think hard about. Let me walk through what that looks like. Picture a married couple, both 67, filing jointly, with income comfortably below the phase-out threshold. They take the standard deduction for married filing jointly, and then, on top of that, they may add the additional amount for each qualifying spouse. The result is a meaningfully larger slice of their income shielded from tax before you factor in anything else at all. But here's the part I want you to be realistic about. What does that actually save you in dollars? That depends entirely on your marginal tax rate. A deduction reduces your taxable income. It does not reduce your tax bill dollar for dollar. Someone in a lower bracket saves less from the same deduction than someone in a higher bracket does. That's the fundamental difference between a deduction and a credit, and it's worth understanding before you get your hopes up about any headline number, including this one. Now, while you've got that return open, here are 4 more things worth checking. These come up every October without fail. Number 1 is estimated payments you've forgotten about. If you made quarterly estimated payments during 2025, every single one of them needs to appear on the return. People miss the January payment constantly because it was made in a different calendar year and it doesn't feel like it belongs. Pull up your IRS online account and confirm that the total the IRS has on record matches what you're claiming. Number 2 is the extension payment itself. If you sent money in with your extension request back in April, that payment has to be reported on the return. If you leave it off, you'll effectively pay it twice, and then you'll spend months waiting for it to get sorted out. Number 3 is that state deadlines are not always the same as federal ones. Your federal extension does not automatically extend every state. Some states follow the federal date, some don't, and a few require you to file a separate form entirely. Check your own state's Department of Revenue, because this catches people out every year. A quick note. Disclaimer. This video is educational information only. It is not tax, legal, or financial advice. IRS Tax Guide USA is an independent educational channel and is not affiliated with the Internal Revenue Service, the Treasury Department, or any government agency. Everyone's tax situation is different, so please verify anything you hear here on irs.gov, or speak with a qualified tax professional before you make a decision about your own return. Number 4 is the retirement account question. Certain retirement contributions can still be made for a prior tax year right up until the filing deadline, including extensions. But the rules differ sharply depending on which type of account you're talking about, and some of those deadlines are not extended at all. Don't assume yours is. Confirm which accounts actually apply to your situation before you count on that money going in. Let's bring it all together. October 15th is your filing deadline. It was never your payment deadline. If you or your spouse are 65 or older, there is an additional deduction available for the 2025 tax year, worth up to $6,000 per qualifying person, phasing out at higher incomes. Make sure it's actually on your return before you sign it, and check those 4 items: your estimated payments, your extension payment, your state deadline, and your retirement contributions. Everything I've covered here comes directly from irs.gov, and I've linked the exact pages in the description below. Please verify your own numbers there, or with a CPA or an enrolled agent before you file. Your situation may not match the examples in this video. If this was useful to you, subscribe. I break down one IRS topic a week in plain English without the jargon. And tell me in the comments, did you file an extension this year, and what tripped you up? The most common questions become the next video.